Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's jump right in. BIDU, ticker BIDU, is trading at $162.28 as of today, January 22nd, 2026. And look, let's not mince words here. We are looking at a massive move. Just a few weeks ago in early January, we were scraping, the bottom of the barrel at roughly $148. What we're seeing now isn't just a blip. It is a decisive breakout from a multi-month consolidation base. If you pull up the daily chart, you see a classic cup and handle pattern. The stock has violently reclaimed its 200-day moving average at 134.49, and we are knocking on the door of the 52-week high, resistance around 165. The momentum is it's undeniable. We have a golden cross formation and an RSI of 58.31. That tells me we are bullish, but crucially, we aren't overbought yet. The tank isn't empty.
The market is certainly moving, I'll grant you that. But let's take a breath before we start popping champagne corks over a technical breakout. The central question here isn't whether the chart looks pretty today. It's whether this is a genuine fundamental turnaround for a fallen angel entering a real bull market, or if we are just seeing a dead cat bounce in what is still a structurally challenged economy. You're citing price action, and that's fair, but I'm looking at the landscape BIDU is pivoting into. They are trying to transform from a legacy search monopoly into an AI ecosystem provider, and they are doing it against the backdrop of China's moderately loose monetary policy for 2026. The stakes are incredibly high, and the ice might be significantly thinner than that RSI suggests.
I see why you might think the ice is thin, given the last few years. Investors have been burned before. But let me give you a different perspective on why this setup is fundamentally different. We are looking at an asymmetric risk-reward opportunity here, driven by three concrete pillars. First, the macro tailwinds. The 2026 China policy pivot, specifically the 4% budget deficit and credit loosening, is a direct injection of adrenaline into BIDU's core advertising business. Small and medium enterprises, the SMEs, are BIDU's bread and butter. When they get access to credit, the first thing they do is spend on ads. Second, the AI inflection is real. The Ernie bot ecosystem has hit 200 million monthly active users as of this month. That is a massive proprietary data set. And third, the valuation is simply dislocated. We are trading at a forward PE of 8 to 12 times. That is a historic low.
Right, and I come at it from a different way. You call it a valuation dislocation. I'd call it a rational pricing of risk. Yes, it's cheap at 8 times earnings, but the China discount is structural. It's not temporary. And while the macro picture has improved with the stimulus, BIDU is facing intense headwinds that money printing doesn't solve. You have ByteDance eating into ad market share aggressively, and effective this month, January 2026, we have the new KCR regulations on data collection. That is essentially a compliance tax on their operations. It adds friction to every dollar they try to extract from that user base. And frankly, while you see a bargain, active fund managers, the so-called smart money like Dodge and Cox, they're selling into this rally. That tells me the sophisticated capital is using this liquidity to get out, not to accumulate.
That's an interesting point about the active managers, and I want to drill down into who is buying and selling in a minute. But first, I want to address the market structure, because the surface-level data, it hides the real story. You mentioned selling, but look at the dark pool activity. For our listeners who don't spend their day on a Bloomberg terminal, dark pools are private exchanges where institutional investors trade huge blocks of shares anonymously. In mid-January, off-exchange volume for BIDU was running between 53 and 58% of the total volume. When you see that kind of heavy volume away from the lit exchanges during an uptrend, that is a textbook signal of stealth institutional accumulation. Large funds are buying blocks off exchange specifically to avoid spiking the price.
I'm sorry, but I just don't buy that the dark pool activity is purely bullish accumulation. It can just as easily be distribution. If the bulls were truly in charge, look at the short interest data. It's down to 2.19% of the float. It has dropped nearly 16%. On the surface, you might say, great, the bears are capitulating. But the flip side is that there is absolutely no short squeeze potential left. None.
The skeptics have already left the building. If everyone who wanted to sell has sold, and everyone who wanted to cover has covered, who is left to drive the price up to your targets?
The buyers are the large institutional allocators returning to the region.
But let's look at who those buyers are. Sure, BlackRock added 1.95 million shares and HSBC added almost 2 million. I see those filings too. But those are passive macro allocators. They are buying China beta because of the stimulus news. They aren't buying BIDU because they did a deep dive on EarnieBot. They are buying the index because their models told them to weight China higher. Meanwhile, the stock pickers, the active managers you mentioned, like Dodge and Cox, who sold over 1 million shares, and PrimeCap, who is trimming, they're rotating out. These are the people who interview management. When the people who analyze the company are selling to the people who just buy the index, that concerns me.
I think you're over-indexing on the active managers who might just be rebalancing. They have portfolio constraints, tax considerations. The fact remains that institutions own nearly 40% of the float, and the net flow from giants like BlackRock provides a massive floor. And while we are on the topic of selling, let's address the insider activity quickly. There was that Form 144 filing on January 2nd, 50,000 shares sold via Citigroup. I know bears love to point to insider sales.
Actually, yeah, I agree with you there. That's noise. It's less than 0.02% of the float. I'm not worried about an executive selling 50,000 shares. I'm worried about the fundamental valuation comparison you brought up earlier. You mentioned it's trading at historic lows.
Exactly. Let's look at that valuation again because the discrepancy is just absurd. BIDU is trading at less than 3 times price to sales. As I mentioned, the forward PE is roughly 8 to 12 times. Now compare that to Alphabet, Google, trading at over 20 times, or Tencent at around 18 times. If you run a sum of the parts analysis, you take the search business, the cloud division, the investments, plus their massive cash pile, you easily get a fair value north of $200 per share. Right now at 162, the market is effectively assigning 0 or maybe even negative value to the AI cloud and the autonomous driving units. You are buying the legacy business at a discount and getting the entire future technology stack for free.
That's a compelling argument on paper, but you have to consider that the discount exists for a reason. You can't compare Baidu to Alphabet. Alphabet is a global monopoly. Baidu is contained strictly to China. The addressable market is smaller. And comparing it to Tencent, Tencent commands a premium because gaming and social cash flows are far more durable than Baidu's cyclical ad revenue. When the economy slows down, marketing budgets are the first thing to get cut, but people keep playing video games. I will concede one thing. Baidu looks better than Alibaba right now. Alibaba is at 11 times earnings but is facing a projected 14% earnings contraction. Baidu is at least projected for 7.4% EPS growth. So yes, it's the best of a bad bunch, but being the cleanest shirt in the laundry hamper doesn't make it a premium asset.
I'm not convinced by that because it ignores the catalysts specific to Baidu's technology stack. You say cleanest shirt, I say hidden gem. You mentioned the future being free. Let's talk about that future. The EarnieBot ecosystem having 200 million MAU is not just a vanity metric. In AI, data is oxygen. That network effect creates a feedback loop that improves the model faster than competitors. And we haven't even touched on the news from January 1st regarding the proposed spin-off of Kulin Sin, their chip unit.
The chip unit spin-off is interesting, I'll grant you.
It's more than interesting. It's a value unlock. With U.S. export controls blocking NVIDIA's high-end chips, Kunlun Sin is a domestic substitution play. It unlocks value in a sector that the Chinese government is desperate to support. That is a catalyst that is not priced in. The market is treating Baidu like an ad agency, but this spin-off highlights they are a deep tech semiconductor play as well.
I come at the AI thesis with a heavy dose of skepticism, largely because of what the prediction markets are telling us. I like to check Polymarket because it cuts through the corporate PR. The probability of Baidu winning the best global AI model race is currently trading at less than 1%. The market knows Baidu cannot compete with OpenAI or Google. And domestically, DeepSeek is rising incredibly fast as a threat. Baidu might have the users now, but developer loyalty is fickle. If DeepSeek offers a cheaper, faster API, those users will migrate. Plus, we have Q4 earnings coming up on February 26th. Expectations are for a kitchen sink quarter.
Okay, explain what you mean by kitchen sink for the listeners.
A kitchen sink quarter is when management dumps every possible bad expense, write down, and charge into one report to lower the bar for the future. Analysts are expecting a 27% year-over-year EPS decline because BIDU is spending so much on CapEx to train these models. The monetization path for this AI is expensive, and margins are going to get crushed before they get better. You're buying into a year of margin compression.
But you are looking at the rearview mirror. That 27% drop is known. It's priced in. The focus is on the 2026 guidance. And speaking of forward-looking data, let's look at the alternative macro data from Polymarket. There is a 79% probability priced in that China hits 4 to 5% GDP growth in 2026. The risk of a hard landing growth under 1% is priced at only 5%. This completely validates the turnaround thesis for the ad business. If the macro holds up, the ad revenue follows.
The macro floor might be solid, but the geopolitical ceiling is lower than you think. Since we are looking at Polymarket, let's look at the tail risks. The contract for will China invade Taiwan by the end of 2026 is trading at a 12% probability. Now, near-term risk for March is only 2%, but that persistent 12% overhang explains exactly why BIDU trades at such a steep discount. It acts as a permanent cap on valuation multiples. You can't expand a PE ratio to 20 when there's a 1 in 8 chance of a geopolitical event that could delist the stock, right? That is the elephant in the room.
That is a fair point on the geopolitical risk premium. But I would argue that at 8 times PE, that risk is more than priced in. Even if you apply a massive discount, the stock is trading as if the company isn't growing at all. So, as we look to wrap this up, I stand by the value growth thesis. We have a technical breakout with support holding at 155. We have the macro stimulus providing a tailwind, and we have a product cycle in Ernie bought that is just starting to monetize. The analyst upper bound target is 188, and given the PEG ratio is likely under 1, the buffer against errors is huge.
I respect the optimism, but I have to remain the value trap watchdog here. Yes, there is tactical upside, but the compliance tax from the new KAC rules is real, and the domestic competition is only intensifying. If that stimulus disappoints, and remember, you are relying heavily on those macro flows from BlackRock and HSBC, this stock will reverse quickly. My advice to anyone listening is to watch that February 26 earnings guidance like a hawk. Specifically, look for the AI revenue contribution. If it's not there, the thesis breaks.
We can agree on that. The February 26 date is critical. For now, the key level to watch is that 165 resistance. If we clear that, the path to 188 opens up.
And if we fail there, we're looking back at the 150 breakout zone. Ultimately, this debate really it rests on whether you believe the 2026 China recovery is durable or fleeting.
Precisely. It's been a fascinating breakdown. Thanks for exploring the nuance with me.
Always a pleasure to dig into the numbers.
That does it for this edition of The Debate. We'll see you next time.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.